Customer lifetime value answers this question. Once you acquire a client, how much revenue they produce from the time they become a client until the time that they're no longer a client. Customer lifetime value. And you're going to compare that to customer acquisition costs, which, as the name implies, what's the cost to get a customer? And I'm going to use an example and also relate these to the inventory turnover ratio and account receivable turnover ratio, because these are all related. So let me give an example. I've used the same auto repair shop for 25 years. The reason is I trust them. They're super reliable. They do so much business. They close at 4 o'clock on Friday. They're not open on the weekends. They control their business because they have so much business and they're reliable. So let's think about the auto repair company. First of all, customer acquisition cost. 25 years ago, somebody referred me to them. That's how they get all the business. It's all referral. They don't do any marketing to speak of. So their customer acquisition cost is very low. Customer lifetime value. I've been paying them to work on my cars for 25 years. Some of those have been pretty big repairs. So I can't imagine how many thousands of dollars they've made over time, and their customer acquisition cost was almost zero. Let's now relate that to the turnover ratio. So inventory turnover ratio is cost of sales divided by average inventory. So for example, if cost of sales was $800,000, inventory is $100,000, you're selling your average inventory 8 times a year. So you want more and more turnover, more sales on a lower inventory level. Well, if you think about the auto repair shop, they don't order parts until they have a customer who needs that part. So in terms of inventory carried at the location, it's virtually zero. Now they make a big investment in tools and equipment, but they don't make hardly any investment at all in inventory because they only order inventory when they have a customer to use that inventory. Accounts receivable turnover, on the other hand, is net credit sales divided by average accounts receivable. And we mean credit, sales on credit, not immediately paid in cash. And by net, we mean we're going to remove returns and allowances, discounts out of that credit sale number. So if your net credit sales were $1 million and your accounts receivable is $150,000 balance, that means that you are collecting all of your accounts receivable 6.7 times a year. So again, similar idea on turnover ratios. You want a big number on the credit sales side. You want a small number as possible on accounts receivable. With my auto shop, almost everybody pays by credit card or debit card. They have no collection issues. So it's a great business. The last thing here is customer churn. What percentage of your clients in a year decide to leave because you have to replace that income? It's a big issue for a lot of SaaS companies.